DuPont analysis is an important financial analysis framework used to evaluate the factors driving a company's return on equity, ROE. The program explains that ROE measures the return generated for shareholders relative to their invested capital, but ROE alone does not reveal the underlying sources of performance. DuPont analysis addresses this limitation by decomposing ROE into separate components related to profitability, efficiency, and financial leverage. This approach helps analysts determine whether strong shareholder returns result from effective operations, efficient asset utilization, or increased use of debt financing. By examining these drivers individually, analysts gain deeper insight into management performance, earnings sustainability, financial risk, and long-term business quality. The traditional three-component DuPont model breaks return on equity into profit margin, asset turnover, and financial leverage. The relationship is expressed as follows. Profit margin measures operational profitability, asset turnover measures efficiency in using assets to generate revenue, and financial leverage measures the extent to which debt financing supports operations. The program emphasizes that decomposing ROE in this way helps analysts identify the primary drivers of shareholder returns. A company may achieve high ROE through strong operating margins, efficient asset management, or high leverage, each of which carries different implications for sustainability and financial risk. Profit margin reflects the percentage of sales converted into net income after accounting for all operating expenses, interest costs, and taxes. Higher profit margins generally indicate strong pricing power, effective cost management, or operational efficiency. Analysts evaluate margin trends carefully because declining profitability may signal rising costs, competitive pressure, or weakening demand. Asset turnover measures how efficiently a company uses its assets to generate sales revenue. Higher turnover ratios suggest efficient utilization of resources and effective operational management. Companies in industries with low profit margins often rely on high asset turnover to maintain satisfactory returns. The DuPont framework therefore highlights the trade-offs between profitability and operational efficiency across different industries and business models. Financial leverage represents the degree to which a company uses debt financing relative to shareholders' equity. Higher leverage increases the financial leverage component of ROE and may enhance shareholder returns during favorable economic conditions. However, excessive leverage also increases financial risk because debt obligations must be serviced regardless of business performance. The program emphasizes that rising ROE driven primarily by increasing leverage may indicate greater financial vulnerability rather than stronger operational performance. Analysts therefore distinguish between ROE improvements caused by sustainable profitability growth and those resulting mainly from higher debt usage. Understanding this distinction is essential for evaluating long-term financial stability and assessing the true quality of shareholder returns. Extended versions of DuPont analysis provide even greater detail by separating profitability into additional components such as tax burden, interest burden, and operating margin. This expanded framework allows analysts to isolate the effects of taxation, financing decisions, and operating performance on shareholder returns. For example, declining ROE may result from lower operating efficiency, rising interest costs, or higher effective tax rates. Extended DuPont analysis therefore improves diagnostic capability and supports more accurate forecasting of future profitability. Analysts frequently use this approach when comparing firms within the same industry because it reveals differences in business strategy, cost structure, financing policy, and operational effectiveness that may not be visible from aggregate profitability measures alone. DuPont analysis is valuable because it integrates profitability, efficiency, and leverage into a comprehensive framework for evaluating financial performance. Rather than relying solely on a single ratio, analysts use DuPont analysis to understand the interaction among operational management, asset utilization, and financing decisions. This approach improves assessment of earnings sustainability, financial risk, and long-term value creation. However, analysts must also recognize its limitations, including the influence of accounting policies, industry characteristics, and historical financial data. The program emphasizes that DuPont analysis should be combined with broader qualitative evaluation of management quality, competitive position, and economic conditions. A strong understanding of DuPont analysis enables analysts to interpret financial performance more effectively and make better investment and valuation decisions.